Welcome to the Supply Chains to Admire research for 2021. The Supply Chains to Admire methodology is now in its 8th year, and it takes us about 4 months to compile all of the data from Y charts. The data that I'll share with you today is for the period of the last decade, from 2011 to 2020. This is a methodology where we analyze each company by peer group, and we look at performance, we look at improvement, and we look at value. Traditionally, supply chains have been all about cost, and we're real mired in functional metrics. And the goal of the Supply Chains to Admire research is to help business leaders everywhere to rethink what is supply chain excellence. Hello, my name is Lora Cecere, and I'm the founder of Supplychaininincights. Supplychaininincights is now on its 10th year, and we bring objective, independent research to business leaders to try to help people to drive a difference. The webinar is divided into several sections. The first section is an overview, a history of the methodology for those that aren't aware. Then we look at what the obstacles are, and analyze the winners and the reason for the winners. Briefly contrast the methodology to the Gartner Top 25, and wrap up with some poignant questions and what your takeaway should be. These slides will be available on SlideShare, and this recording will be available on our YouTube channel, and we invite you to share it freely. There will be a follow-up slide deck that will have all of the orbit charts of all of the companies in the peer groups and the winners. And there will also be a report that we will be sending out by the end of the month in our monthly newsletter. So we look forward to your questions, and with that, let's begin. So the Supply Chains to Admire methodology started because we needed an objective measurement to look at what drives supply chain excellence and how do we help business leaders to make a difference. And we wanted to have an objective methodology that would allow companies to really think hard about what is supply chain excellence. I got to tell you, I have been studying supply chain excellence for 2 decades, and the more I study it, the more I realize that the supply chain is a complex, nonlinear system, and that the traditional ways we measure excellence, functional metrics, throws the supply chain out of balance. And so we need a balanced scorecard to allow companies to align, but companies don't naturally align. And over the last decade, the commercial teams have become more misaligned to the operational teams, and you'll see that in some of the analysis. This analysis is of publicly traded companies, so no private companies, because we can't get to the data and we can't get to the divisional data. So it is for a corporation. The data comes from a syndicated data provider named Y charts, which looks at all of the publicly trading information across the globe, and we basically spend time bringing it into peer groups and applying the methodology that I'll explain today. We divide the companies into peer group sectors, and that's a little bit of the art. Over the last 8 years, we've worked on defining and redefining and thinking about the public sectors, and it isn't a pure science. For example, what is J&J? Is J&J a pharmaceutical company, a consumer products company, or a medical device company? Well, everybody knows they're all three. We can't get to the individual data, so we basically place J&J in the pharmaceutical industry because of the prevalence of the revenue for that particular industry. It is not an absolute science, and we try to do our best. And here we're looking at the period of 2011 to 2020, and you might say, well, why so long, Laura? Why not look at a shorter duration? And my answer is really twofold. One, my observation from working with over 600 companies is it takes at least 3 years to start a program, and often it'll take 5 to 6 years to be able to drive really meaningful results. For example, Ecolab, when we first started this program in 2014, was starting to make improvement, but they had breakout performance in 2018. Likewise, Annette Clayton's work on the end-to-end work on Schneider Electric started in 2015. Schneider's still on the journey, but you'll see that they don't make it into the winner's circle because of underperformance on growth and inventory. But they're driving improvement, and I expect that they will break through into the winner's circle in 1 to 2 years. But a shorter term duration of 1 to 2 years really doesn't tell us much. So we're looking at the long duration. The other thing was I wanted to look decade over decade because we've gone backwards in this past decade in terms of improvement and performance, and I think that's a wake-up call for us. As supply chains have become more global, as we've had a lot of consolidation and mergers and acquisitions, the corporations have become very political and they're not really clear on supply chain excellence, and I think it's a wake-up call. Also, I think it's a wake-up call that of 600 companies analyzed, 20 companies outperform their peer groups. And this is an analysis of, do they drive improvement faster than their peers? Are they outperforming their peers? And are they driving market value? So that's not a lot. I mean, do the numbers. That's a small subset of companies. And also, the names are not companies that you would normally think of as the natural supply chain leaders. When I started this work, who I thought was really doing a great job on balance sheet performance turned out to not be the same set of companies as when I looked at the analysis. And this data is hard, right? Because it takes us, 4 months every year to analyze the data, and we've been looking at it year over year. So it is not a trivial exercise. So with that, let's roll up our sleeves. The methodology, now in its 8th year, was started because I wanted a way to have an objective analysis to compare my research, to be able to look at companies that were outperforming peer group, underperforming peer group, and average, to be able to answer the question of, so what, who cares? What practices are really driving value and improvement? And we had to do this against a peer group, so that took us a long time. And the work to determine the balanced scorecard was actually started with Arizona State University in 2014, where we looked at the financial data from 2006 to 2011, and we analyzed what group of metrics drove the highest correlation to market cap. And the first metric that pops out at that correlation level was growth. Companies that are driving growth tend to have higher market capitalization. But the other metrics, because we wanted to have a balanced portfolio of data that we could easily get to, we decided to look at margin, not cost, but margin. Operating margin has a higher correlation to market capitalization than cost. We looked at inventory turns. Working capital is a compound metric, and it's pretty dangerous because one of the things we've done is we've elongated payables and not necessarily made improvements in inventory. So we wanted to put inventory turns front and center. And at the intersection of margin and inventory turns, we find distinct patterns. And also we wanted to look at return on invested capital. Our observation is that as companies sweat their assets, inventory as a buffer becomes more important. And since the supply chain is a complex nonlinear system, we can't just look at a simple triangle of inventory versus cost versus customer service. That return on invested capital is really essential. I would love to be able to include customer service in the analysis, but I don't have a good data source to be objective about that. So we look at growth, operating margin, inventory turns, and return on invested capital. These are 4 metrics that are well defined on the balance sheets and we can get to readily. So why are we doing this? We wanted an objective measurement for our research. We wanted to help companies to benchmark and build balanced portfolios. I often see companies develop strategy documents that are not in alignment with the potential of the market. And so I wanted people to have a benchmarking tool or an activity every year. And we wanted to help people to understand how the things that they do, the choices, drive balance sheet performance, and then help business leaders to talk the language of finance, to talk about how we can drive value as we build the digital twin and we try to do simulations to help companies drive value and build an objective standard that's data-driven. No politics, no beauty contest, all data. You know, we're hard at it. It's a very data-driven. And we wanted a methodology that looked at resiliency, which is really top of mind right now in the pandemic, ability to drive year-over-year results. And you can see that the winners in this supply chain to admire drive year-over-year results. They're balanced. They're able to bring all of the metrics above their peer group, and you'll often see that companies are out of balance. They're either driving an inventory strategy or they're driving a margin strategy, but they're not driving a balanced portfolio strategy. And we wanted to be able to look at a measurement for performance and improvement and deliver value. So the balanced scorecard, year-over-year growth, operating margin, inventory turns, and return on invested capital. Now, internally to a company, I would add customer service, but again, I can't find an objective measurement for customer service. And I would also add corporate social responsibility, but again, I can't find a good metric or a set of metrics for the industry on corporate social responsibility. So the methodology works like this. We divide companies into peer groups. We apply the supply chain index, which is the study of orbit charts. It's a vector analysis of orbit charts, and I'll show you some orbit charts. And we look at, are they driving improvement? If they're driving improvement faster than 2/3 of their peer group, they go to the next part of the analysis of, are they driving value better than their peer group in either price to book or market capitalization, that's an or condition, and are they outperforming the peer group on growth, operating margin, inventory turns, and return on invested capital. Now, this tension between improvement and performance is an interesting one because companies that drive improvement fast are typically not top performers. It's a lot like losing weight and going to the gym. The guy that has a lot to lose will drive improvement faster than the guy who's really lean. The companies that drove improvement quickly in the early part of the decade struggle now to outperform their peer group. So in this particular analysis, Procter & Gamble fell out of the supply chains to admire right about the time of the Gillette acquisition. They weren't able to outperform their peer group in growth coming out of the Gillette acquisition. Likewise, L'Oreal falls out of this particular peer group because they aren't able to drive improvement even though they were a top performer for 5 years. So when you're driving a strategy in supply chain and you're driving improvement, you get to a certain point where you've got to change what you do to really take it up a notch. And that's where companies struggle because they're not looking at peer groups and they're not thinking about the tension between improvement and performance. And the improvement analysis is based upon the orbit chart analysis of the supply chain index, where we're looking at the patterns in the orbit charts, and I'll show you some orbit charts, where we're looking at the intersection of inventory turns and margin. We're looking at the intersection of operating margin and inventory turns and the tightness of the pattern, because if a company's swinging back and forth, they're really not resilient. And then we're looking at the intersection of growth and return on invested capital. So this is how we measure improvement, to be able to look at the orbit charts and the vector analysis for those particular peer groups. Now, no doubt about it, in the last particular decade, we've had our challenges. And in fact, we had 20 more days of inventory across all industries going into the pandemic than we had at the beginning of the 2007 recession. And you might say, well, with all the problems that we have with ships in the water, whether we've got, the Suez Canal issues, or we've got, 30 more ships on Bay and Long Beach, or we've got the issues now with COVID unloading in Shenzhen. Problem was we didn't have the right inventory. We're not able to manage form and function of inventory, and only 9% of companies are actively designing their supply chains. We've only looked at safety stock. We haven't really embraced inventories as a buffer. In transit inventories have grown, and we've become worse in the management of cycle stock. And the issues in the supply chain, and I'm an old gal, I've been studying this for 2 decades, haven't changed. People are struggling with visibility. We think about visibility too narrowly. We don't think about the logical data model that's got to go across disparate systems. And most companies have 20 different visibility programs on the go, and they're not clear on what visibility means. And we're not aligned. In fact, over the last decade, we saw a bigger gap in commercial teams and operational teams. And one of the things that we find in companies that really outperform is they're very closely aligned. So, we might talk about best practices, but I think we've got to be humble. We have too many metrics. I work with companies that go into sales and operations planning with 50 metrics, and I'm like, a balanced scorecard should be 7 to 9 metrics. Focus on functional performance. If I focus on cost by function, I'll throw the supply chain out of balance. Only 29% of companies can get to total cost, only 3% can get to margin, and that's despite all the investment in analytics. Singular goals with a short-term focus, right? We've got to manage that we plan, we execute, we design, and lack of awareness on industry potential and performance, and confusion between financial reengineering and the delivery of value. So we've chased a lot of financial reengineering projects, whether it was labor arbitrage and chasing the lowest cost of labor, or whether it's tax efficient supply chains. We've really played around with a lot of financial reengineering without holistically managing supply chains as a total balanced portfolio. So with that, let's get to the winners, right? In the winner's circle in 2020, there were 22 award winners. And you can see that there were 3 in retail, 5 in process, and 14 in discrete. Over the 8 years as we've worked on this methodology, we have had fewer and fewer companies to be winners in the process industries. Now, as we go into the 2021 winner's circle, we have some returning companies. TJX returns, a very unique retail channel. I encourage you to go to TJX and look at how they do broadline retail for the dollar-conscious shopper. AbbVie, which has a very unique pharmaceutical model, very young company. Ecolab, which I'm very proud of, really drove amazing improvement performance in the chemical sector. And then in the discrete industries, TSMC, which has one of the most effective networks I've ever seen, which shares the capabilities of semiconductors upstream with their trading partners, and a lot of innovation around chip design and capabilities. Lockheed Martin, which has done incredible work around maintenance and programs and repair around aircraft. Broadcom, a long leader in their particular industry. Sleep Number, who spoke at our conference last year, and we do our conference each year in September, owns the supply chain all the way to the customer with white glove delivery. They actually say they don't sell mattresses, they sell sleep. And so they've got the largest database of sleep and sleep analysis for the mattresses of any company. And it's a fabulous case study. I would encourage you to read it on the Supply Chain Shaman if you haven't already seen it. ASSO ABLOY, which makes locks and home utility devices, very no-nonsense company, European foundation. And PACCAR, which is a long leader in lean and heavy equipment. These companies return to the winner's circle. And added to the winner's circle is Dollar General. Now, over the 8 years, and I'm going to actually use Dollar General as an example to show you the orbit chart analysis, Dollar General has won 5 out of the 8 years. Ross has won 4 out of the 8 years, and Nike has won 3 out of the 8 years. These 4 companies return to the winner's circle in retail. And you can see in process, all of our consumer products and personal products companies wash out. One of the issues is that traditional marketing and sales approaches in consumer products and personal products shift demand versus shape demand, increasing cost, degrading margin, and most companies are underperforming in growth. And so the concept of I'm going to milk the dollars in the back office and put them into trade programs in the front office just didn't pan out. And it takes companies in that sector 4 to 6 weeks to measure traditional trade incentives. And meanwhile, we've had a lot of young companies grow up around companies, and mergers and acquisitions didn't go very well in those industries. Celanese and Air Products, very no-nonsense chemical companies, not as large as BASF or Dow, very focused on their customers, come to the winner's circle. And you can see that Western Digital is one of the most interesting companies to me around analytic strategies. They bought SanDisk. SanDisk was one of the best companies that I've ever interviewed in planning. I wrote a case study on that, and they've been doing incredible work around analytics, scorecards, and looking at how they're servicing their customers. Intuitive Surgical, robotics for medical device, very cool company, innovative. Apple returns. Apple is an incredible money machine. Inditex, you may know Inditex from Zara with apparel. Tempur Sealy, another mattress company, and Navita. So these are our supply chains to admire 2021 winners. So with that, I just want to go through some details of how we determine the winners and what I think it means for you. So over the periods that we've done this particular analysis, you can see fewer and fewer process companies actually qualify. And more discrete companies are actually making it to the winner circle. And let's look at the patterns. So 5% of retail was actually in the winner circle this time. We analyzed restaurants, apparel, broadline, drug, home improvement, and grocery. And you can see the average revenue, and I've got them stacked ranked by operating margin. So restaurant margin is the highest, and then you can see that grocery retail margins are the lowest. And then we're looking at these as the averages for the industry. Process industry, 2% winners, and you can see the number of companies by industry sector, and you can also see the operating margin. Typically, the higher the margin of a company, the less concerned they are about supply chain. And then when we look at the discrete industries actually perform better on this methodology. I just want to note on process before I move on that traditionally, we've had beverage companies in the winner circle. Monster's made it before, and Coca-Cola has made it before. The beverage companies did not make it, and nobody made it from personal products. So our traditional winner has been L'Oreal, and while L'Oreal does a great job on new product development and new product launch and service to the consumer, not as strong on inventory management, not as strong on planning, and they fall out on the inventory analysis and managing inventory through the pandemic. Now, in the discrete industries, 4% of companies are winners, heavily in the semiconductor sector, as you can see. And you'll see that automotive, which has typically been much more about sticks than carrots, not collaborative, struggles in the sectors. And also you can see that the margins on many of these industries in the high-tech industry are falling. So the need for supply chain excellence increases. And one of the things that we do in sharing the report and the analysis is hopefully give companies benchmark data so that they can basically build their balanced scorecard so that it's realistic. So let's take an example. I just want to show you how we do this. So in the report that we'll publish in a couple of weeks, you'll find that each industry, and this is retail broadline, will have the names of the companies, it'll have the revenues, it'll have the supply chain index, which is the measurement of improvement, growth, inventory turns, operating margin, return on invested capital, price to book, and market capitalization in these charts. So the way we do this is we first look at improvement, which is the supply chain index, and we take companies that are in the top 2/3 of improvement. And this is a vector chart analysis of the orbit charts. And you can see that Dollar General is number 9 on improvement. Typically, it's not the company that's top in improvement that's going to win. It's usually a company that's still making progress year over year, but it's consistent progress. And then look at the performance metrics of growth, inventory turns, operating margin, return on invested capital. Now we throw out the outliers and we start to look at the averages of performance for that particular company within the peer group. So you can see Dollar General outperforms on growth. Dollar General is within the margin on inventory turns, and they're outperforming on margin, return on invested capital, and also value. Now on inventory turns, we did give companies a 5% grace, plus or minus on the averages, and so Dollar General slips in with that grace period. Dollar General and Nike both slip into the winner's circle on that. So here we have broadline retail and we have Dollar General, and this is the operating margin versus the broadline retail averages. And you can see that Dollar General is outperforming the broadline retail. Now, the way you look at an orbit chart is you to basically start the plot of 2001 to 2020, and you can look at the company performance. And here we have growth versus return on invested capital to be able to look at the patterns. And again, the improvement is coming through the patterns. And then the averages are in the boxes, and it allows you to look at the patterns. So the supply chain index and the supply chain stood Meyer is a study of patterns. And this is Dollar General's performance over that period of time, so from 2011 to 2020. And you can see it's been really a study on margin. They have had falling inventory turns. Inventory turns have also fallen in this particular peer group over time, but it is a study of retail performance. Now, sometimes people will ask me, well, Laura, how does the supply chain stood Meyer compare to the Gartner Top 25? And, you know, I just throw this in here because there's no perfect methodology, and I want you to understand the difference. You know, the supply chain stood Meyer is all data-driven, 600 companies. We look at peer groups, no revenue minimum. The Gartner Top 25 is for big companies and roughly 300 companies, and it's a shorter term analysis than the supply chain stood Meyer. Gartner Top 25 includes 50% opinion, 50% quantitative analysis, and then I went through how we actually calculate the supply chain stood Meyer. Now, data-driven, comparison to peer group, long view, those are the characteristics I want you to remember about the supply chain stood Meyer. When you compare the methodologies, there's only 4 companies that are the same as winners on those methodologies. And, you know, so you might say it's a good thing to step back and look at the data because you must define what is supply chain excellence for your company using the data. And we look at the Gartner Top 25 and we found that 75% underperformed on growth for the period of 2011 to 2020. So it's got a bias for underperforming companies in growth. 29% underperformed on margin. It has a more of a cost-based bias, and 42% underperformed on inventory turns. So this is an analysis of the companies in the Gartner Top 25 and the difference between the peer group analysis and the company averages for the period of 2011 and 2020. Now, if you remember, the Gartner Top 25 does not look at peer group at all. It basically takes all company and puts them in a spreadsheet and shakes them up, which was always my issue when I worked at AMR, and we came up with this methodology of how do you compare BASF to Apple meaningfully? How can you compare a Walmart to TSMC meaningfully? And so I think that it, it behooves us to step back and to really think about what is supply chain excellence. And this is P&G. These are orbit charts for the Gartner Top 25 P&G. Now, P&G's growth is 1%, minus 1% against an industry average of 2%. So you can see while P&G is outperforming the industry peer group on both margin and inventory turns, they are underperforming on growth. Now, when I talk to my P&G friends, they're like, well, Lora, growth is really not the supply chain mantra. It's not really what we're driving. And I'm like, but it should be. And, one of the issues is P&G did not do a good job on the mergers and acquisitions and is sort of ridden on historic perception of supply chain excellence. This is Cisco. Cisco is number 1 in the Gartner Top 25. You can see that Cisco has growth significantly below the peer group, even though they're better on margin and they're slightly under on inventory turns. So I think growth is important. Here's J&J. J&J is outperforming on margin and outperforming on inventory turns, but they're not performing on growth. And so when I talk to J&J, again, there's like, but we're very financially driven, very cost driven, we're not responsible for growth in supply chain. And I'm like, but supply chain needs to be an engine of growth in my perspective. And we need to be able to look at margin, and we need to be able to look at market drivers versus supply chain shaping levers, and how we're shaping versus shifting demand, and how we're designing the supply chain. Here's Schneider Electric. Now, Schneider Electric is one of my favorite case studies of end-to-end supply chain. Now, Schneider Electric has 110 ERP systems. When they started their end-to-end supply chain journey, they consolidated down to 80. They struggle with master data. They struggle with global governance, but they did a great job on driving digital innovation. Murad and Annette Clayton did a great job of defining what was an end-to-end supply chain, and you can see that over time they've driven improvement, and they've also driven performance against the peer group. I expect Schneider Electric to make it to the Supply Chain Studmeyer Winner's Circle maybe next year. They're really moving on. And here's Nestle. Nestle's number 5 in the Gartner Top 25. 1/5 the rate of growth of the peer group. And you can see Nestle is outperforming in margin, underperforming in inventory turns. And, there's no one right answer on supply chain excellence, but I do believe the supply chain needs to be an engine of growth, and that we need to define a balanced scorecard that is relevant for that peer group, and then manage ourselves against it. So here are the questions that I get when I write my blog posts and I speak. And the first is, on my balanced scorecard, why did I not include customer service? There's no good data source for customer service. I truly, in my heart, believe it's the most important supply chain metric, but you just can't measure it across peer groups. So I can't use it. It doesn't mean it's not important, and doesn't mean it shouldn't be on your balanced scorecard. I also am an environmentalist. I worry about the planet. I worry about the fact that 93% of companies have glossy and beautiful corporate social responsibility documents, and only 20% are actively building networks, and 72% of the non-renewable resources of the planet are in the networks. And I think that we are not true to our mission for corporate social responsibility. I would love to include corporate social responsibility data in the Supply Chain Studmeyer, but I cannot find a good data source. I believe that self-reported data is self-serving by companies, and I'm looking for a good data source. So if somebody knows one, please let me know about it so I can research it for next year. But I know of no good data source that really can go across all peer groups and all saw the sizes of companies. It's an interesting question I had last week is why did I not divide the companies into classes, sort of like wrestling groups, like, you know, small, medium, and large. And the reason is the small companies outperform the big companies, and I don't need to. You know, what I find is a small company that's very focused on customer service, has clear supply chain strategy, has really not gotten into the political quagmire of functional metrics, outperforms the larger companies. And I find that as companies go through mergers and acquisitions without the balanced scorecard and without the clear definition of supply chain excellence, they get very caught in functional metrics, throw the supply chain out of balance by looking at, you know, manufacturing cost and OEE and purchase price variance and transportation cost, and they're not able to look at margin, and they're not able to look at what the customer really needs, and the supply chain's totally thrown out of balance. So I don't feel the need to divide into classes. Then I also had a question last week about why do I not look at working capital versus inventory turns? And if you look at cash to cash is a compound metric of receivables plus inventory minus payables. And what has happened is we've not done a good job of managing inventory over the last decade. Our companies have become more global. We've not managed in-transit inventories. We've not managed cycles. Only 9% of companies actively manage buffers and inventory. But we've elongated payables. So we've offset and improving cash to cash the higher inventory with the elongation of payables. And so I want to focus on what we can control. I think compound metrics are really dangerous because it's slippery, like what part of it do we want to control? So I'm really very focused on inventory turns because we're measurable, it's important, and it's controllable by the supply chain leader. And then the last question is growth. Why am I penalizing companies that have high margin and inventory turns because they've not grown? And it's because I think the supply chain is the engine for growth. And what I see in the discrete companies that I don't see in the process companies is the alignment of the organization to drive growth. And, you know, I'm just trying to help us to learn to unlearn to build better. I believe that we can make the world a better place. I believe that supply chains drive economic value, but I don't think we can sit back and when we have really large gaps between commercial and operations teams and we don't know our customers and we're not aligned to a balanced scorecard, that we can say we're driving supply chain excellence. And our traditional programs are all about transactional efficiency, functional metrics. Companies don't have balanced scorecards. They're not really looking at peer groups, and I want to change that. So my recommendation to you, start by defining supply chain excellence. I share all this data publicly. The full report will come out in a couple of weeks. Use the data, have a hard talk with your organization about what is supply chain excellence. Just don't get caught up in, you know, simple discussions of I want to have an end-to-end supply chain. Define what an end is, define what an end is, and look at what is excellence. So in summary, there's no perfect method for determining supply chain excellence. I'm hoping to stimulate a conversation to drive a meaningful discussion within your organization. Second, business leaders' perceptions of corporate performance are not aligned with balance sheet results. The companies we think are outperforming are not. The companies that are on most of the stages of our events, beating their chest about how they've done a great job, are not the top performers. I think we need to reward the companies that have driven performance at a balance sheet level and done the hard work of managing margin, inventory turns, and driving growth, and that is the purpose of this report. Only 4% of companies outperform their peer group. Isn't that sad? Peer analysis matters. Year-over-year focus on supply chain excellence matters. And that is the supply chains to admire for 2021. So let me see if I have any questions. I would love to see your questions in the chat panel. If anybody has any questions, please let me know. And, I will be glad to answer. First question is on customer service. Do I have anything that I believe could be tracked and objective? No, I do not. I've studied this for years, and I have found no metric for customer service that I think can be used in this kind of analysis. But I do think you can do a similar analysis within your divisions where you can look at customer service, and I would encourage you to do that. Let's see if there are any more questions that are coming in. One person wants to know where they can get the slides. We will share the slides on SlideShare. We'll share this presentation on YouTube, and we'll also be having Supply Chains to Admire award winners presenting at the Supply Chain Insights Global Summit. We will be doing a virtual and shared session of the summit, so we're hoping to see everyone there as we talk about supply chain excellence and the future of supply chains as we face 2030. So, as you think about supply chain excellence and you use the supply chains to admire analysis, use it to drive hard-hitting discussions within your team. I have a question. Automotive appears to have a hard time reaching a top spot. Any thoughts on why that is? Well, I think automotive is the classic example of what we need to forget and rethink in supply chain. Automotive does not do a good job of managing demand. People don't have the cars that they want and the time cycles they want. They don't use the click-through data on configurators on demand. They're very focused on manufacturing excellence. And they've only had big sticks to beat their suppliers, right? They don't have the networks of TSMC or NVIDIA. They are always very focused on, suppliers jump when I want you to jump. Collaboration is not a word that automotive understands. Automotive has done a good job on platform rationalization, but has not done a good job on value chain design and managing the balanced scorecard. Very traditional, very functional metrics, mired in politics. A lot to learn from automotive that we don't want to emulate. And, historically, in the supply chains to admire, BMW won the supply chains to admire in 2016. I've seen Audi come close, but the North American automotive companies have never made it. Likewise, I think that Toyota has been just a tremendous leader in driving lean, but I think that lean is only a good tactic for the efficient supply chain and very high volume and very predictable. And most companies have rolled out lean in very bad ways where they're very focused on functional lean. And so I think it's a good case for us to learn from automotive. A&D, I think Lockheed Martin has done some great work around performance and returns and a lot to learn there. Great supplier development programs at Lockheed. When you call the Lockheed help desk and your supplier and you need to know quality of conformance data, you get a senior supply chain engineer that can answer questions, very focused on collaborative supplier development work. So it's a good case study for us to learn from that perspective as well. Okay, I'm going to wrap up now, and hopefully I'll see you at the Global Summit, and you can see the case studies that I'm going to write on the supply chain shaman as we continue our journey to understand supply chain excellence. You can follow me on LinkedIn, on Forbes, and in my writing on the supply chains to admire. on the Supply Chain Shaman, and this is a little bit about me and where you can find me. Thanks for joining us today for the webinar. I hope it helps you and your organization. Until next time, this is Laura.